Hi, welcome to Ventura. Few minutes, we're going to tell you what a long strangle is and when you should try to employ it. Then we will tell you what it exactly involves, what you can expect to gain or lose if the stock moves as per or against your expectations, and finally we'll run you through a practical numerical example to illustrate the concept and then review the same as well. A long strangle, like a long straddle, involves going long or buying options. It involves buying a call option and a put option at different strike prices, but with the same expiration date. Now, when should you employ a long strangle? The most essential condition for this strategy to deliver gains is that the market must be highly volatile and move considerably either upwards or downwards. Now, here's what you need to do to make a long strangle. You buy a put option on a particular stock or index at a strike price that is out of the money. And simultaneously you buy an out of the money call option with the same expiration date. Now, what's the rationale for a long strangle? If your view on the market turning volatile is correct, your upside potential is unlimited, irrespective of which way the market moves. The further away the price is at maturity from the strike prices of the options, the better. If, on the other hand, the price of the underlying remains relatively steady, falling in between the strike prices of your options, all you have to lose is the cost of setting up the strategy, which is the total premium that you have paid. In a long strangle, your returns are potentially unlimited and depend on the extent to which the maturity and the strike prices differ. Your risk, however, is limited to the premiums that you pay. Here's an example to make this strategy really clear. Let's suppose Nifty current month future is at 6,000 and you feel it will move considerably by maturity. You could set up a long strangle by buying one call with a strike price of 6,200 and simultaneously buying a put of 5,800 of the same maturity. This strategy would cost you around 100 rupees in the form of premiums paid. And this is what your payoff graph will look like. If at maturity the price remains between 5,800 and 6,200, you lose the 100 rupees that you have paid as premiums. If, however, the price rises or falls above 6,300 or below 5,700, you start making gains. Anything within the range of 5,700 and 5,800 and 6,200 and 6,300 will result in some loss, as you will recover only a part of the premiums that you have paid. Here's a look at the numbers behind the graph. As you can see, we have two break-even points, one at 5,700 and another one at 6,300. Now your max loss scenario is if Nifty ranges between 5,800 and 6,200. Once Nifty falls below 5,700 or goes above 6,300, your profit will be to the extent of the change. Thus, the potential profit is actually unlimited. Now let's summarize our example. The cost of strangle is 100 rupees, which is nothing but the net premium paid. The net premium paid is also the maximum loss you can incur in this strategy. The maximum profit is unlimited below the lower and above the upper break-even point. Now, how do we get this upper break-even point and lower break-even point? The upper break-even point is over here 6,300, which is nothing but the call strike plus the cost of the strangle. And the lower break-even point, as you would have guessed, is 5,700, which is the put strike minus the cost of the strangle. You're probably now clear about the reason for structuring a long strangle, which is basically the expectation that the stock or index will move considerably. Remember that it is time to exit this strategy when the market looks like it's going to be range bound between your strike prices. To quickly recap, a long strangle is a strategy that can be applied to a market, index, or stock that is expected to be volatile. It carries a limited risk, but the scope of returns are unlimited. So, in a nutshell, it's a strategy for traders who seek limited risk and unlimited profit. Thank you for viewing our presentation.